This is the weekly economic and market update for August 5th, 2022, and August 8th, the week beginning August 8th, 2022. And the three areas I cover are my personal sentiment and the investor sentiment. The second area are economic and market measures that are significant for the upcoming week, and then a commentary on this case will be what makes a strong economy. So my sentiment currently is I added in last week a micro sentiment, which is I'm 10% bullish, I'm 70% bearish, and I'm 20% neutral. And my expectations are, because of the run up that we've had, that we'll see things back off. Now, I expected that last week, and it didn't move a lot. And I really expected a bigger reaction to the jobs report, although I didn't think that would be the impetus for a decline. I thought it would just be because we've run up so fast and we needed to take a break. Short term, I am 70% bullish, 30% bearish, based on the fact that I still think we're going to get a run up even higher than where we're at right now, before things really start to deteriorate. Midterm, the 3 to 12 month time frame, I'm 30% bullish, 70% bearish, and then long term, as if you've watched before, I'm 100% bearish, with the belief that we'll be in a depression at some point during next year. Now, the investor sentiment is it changed a little bit. It seems to be improving, where you've got investor sentiment at 30.6% bullish, 30.6% neutral, and 38.9% bearish. And these are all trending upward. Nothing really significantly different, other than we're starting to see the bearish sentiment get towards the historical average of 30.5%, but still quite a ways away from. There's still a lot of fear in the market, and people are playing a lot of puts with the expectation that the market's going to go down a lot more. For the economic and market measures portion, looking at the 10-year Treasury Yields, and again, this is a harbinger of kind of how things are going right now. It's up a little bit in the 5 days this week. Started at 2.67% in essence, and now we're up around a little over 2.8%. And there is some expectation that this number may go up again one more time when we get this decline, as far as 3.2% on the U.S. Treasury note. And the bond market is doing the tightening. The 10-year is something to watch. And I'll probably do something on inverted yield curves at this point, because those are kind of future forecasts for recessions. We've had a few inverted yield curves in the bond market, and so the expectation is that if you don't already think we're in a recession, then it's in essence coming. My personal belief is, with the 2 quarters of GDP, we are already in a recession. Let's take a quick look at the DXY. And the DXY is primarily been trending down. It started back up went up 88 cents. This is the U.S. dollar currency index, and at $106.62. That's elevated pretty high for the dollar. I mean, all time. And if you haven't watched my video on the Milkshake Theory and why you need to understand it, this is one of the reasons I keep track of it, is because if this thing gets back up around 109, 110, 111, as Brent Johnson expects it to, then I would expect that this would be something things will start breaking in the global economy, and because we're the Milkshake Theory taking the liquidity from other countries, and but that could also be the reason that we get either a melt up or a really strong bear market rally from where we are now, based upon everybody is investing their money in the U.S. either as a safe haven or the fact that even though our economy is awful, it is the best of the ones that are out there, and that's a sad statement of the global economy, which is one of the reasons I believe that we're headed towards a depression next year. If we look at non-farm payroll, which has obviously took the headlines this week, everybody touting a wonderful economy because we have 528,000. I mean, there's a lot of things, negative things. I'm glad it's up. I mean, I'm not sad that it's up, but at the same time, this is not what makes a strong economy, and this kind of will forward into my commentary on what makes a strong economy. It's not just the jobs; it's the quality of the jobs that you have. And a lot of these 528,000 that were created were service jobs, and they were also second jobs for people. And we have the highest number of people ever working second jobs. So this is one of the reasons why this number is up. But I do expect this number to go down. It is a lagging indicator that the Fed is following, which is one of the reasons why we're getting the global economy and the U.S. economy driven into the ditch because they're watching the wrong things. One of the right things that they could be watching are the jobless claims. They can start to see that, over the last few months, we're starting to get a trend up in the number of jobless claims. And this is a leading indicator. So, if these things start to spike, then you could still be hiring into as you're in a recession, because again it's a lagging indicator. When the unemployment rate or the number of jobs created was 528,000, now we're looking at an unemployment or the initial jobless claims of 260,000. So I'd look for this number to tick up, and I do expect the unemployment rate it's going to catch up with it at some point. The economy is not strong. So let's talk about what makes a strong economy. Now, with the unemployment rate lagging and with the leading indicators of initial jobless claims, what creates a strong economy is when you make stuff like China is doing for us. They make a lot, they manufacture a lot of the goods that come here to the U.S., and they save. They are savers. And we have a service economy, and we are spenders. And when you look at the you look at the unemployment increase, that came out on Friday with 528,000 jobs, the first thing that you will notice, or the first thing I notice, is that only about 12% of those jobs were in manufacturing or mining or something that actually creates things. And this is the problem with the economy, is especially the Keynesians, which are in power right now, which is the Democrats, are focused on the demand side of things. Oh, well, people are buying stuff, and they're not really looking at how much debt we're accumulating in buying stuff or keeping up with inflation. And so what you wind up with is a very weak economy because we're not supplying anything. The service sector is strong, but that's not the same as manufacturing. And for all the talk that both Trump and Biden have talked about, we're going to bring back all these great manufacturing jobs that we need here in the U.S. I agree with that, but I haven't seen anything other than The bill that they passed, where they spent 250 billion on um, uh, semiconductor and chips manufacturing. So it's something that creates weakness in the economy. And one of the things that we need to do is bring this manufacturing back. And I believe me, I think it's going to happen pretty fast, because when the depression comes next year, a lot of these jobs will be gone. And I think we'll start to be getting bullied by some other countries. How it all plays out, I'm still piecing it together, but in essence, my expectation is that we will see unemployment increase. We will see initial jobless claims increase. I do also believe that we'll get a third quarter of negative GDP next month. And how fast it deteriorates, I don't know. Will the Fed pivot and, or at least they're in a pause right now, but it's a calendar pause, not a intention pause, although they're supposedly looking at numbers in the meantime. But they're meeting Jackson Hole later this month. And, I don't know what they talk about. It'd be interesting. There'd be a fly in the wall in that meeting. But yeah, we don't have a strong economy, and we haven't for quite a while because of the lack of manufacturing that's going on in this country. And because we're not making things, we have trade deficits, and, we're at the mercy of a lot of our enemies at this point. The oil thing, to me, is just insanity, that we're not drilling our own oil and sending it around the world. We could be doing that, but you have to have a longer view of how needed or how in demand oil is going to be for the next 20 years. Yeah, I'd love to snap my fingers and see green energy go into force, but you got to build nuclear power plants. Windmills will never make it as far as being something to rely on. Same with solar; the sun doesn't always shine, and it's just some of the things that we're doing economically. You want to get inflation down, pump oil, sell it around the world, and the lease claims and all the stuff that are is a fog to what is actually going on, because you can't. It requires more than just leases, and I've talked about this before. For oil, you have to have, you have to navigate the regulations that this administration has put in place that are a barrier. And you also have to have some long-term outlook that building something that's badly needed, are refineries in this country, as something that you want to invest in. And, oh no, we're not going to spend any money on that. And then when you go to mine a lot of the things that you need for, like silver and nickel and cobalt and all those types of materials that you're going to need for a green economy, there's more regulations. And, people are worried about the mud dauber in Virginia, or whatever fish or bug or bird or whatever might become extinct. We've got to work around these things as far as a country. So anyway, that's my commentary this week. We do have a weak economy, and it goes much deeper than just the state of things today. We need to become a country that manufactures and saves, as opposed to being all demand side of the supply and demand curve. Demand does not give us the supply. We need to make our own stuff, and we're just not moving that direction with any speed whatsoever. So that's it for this week, and remember, there is always a better way.